This is the Chapter 2 in-class assignment review video for Section 55. More Delivery Service completed the following transactions during December 2025. On December 1st, More Delivery Service began operations by receiving $20,000 cash and a truck with a fair value of $13,000 from Robert Moore. The business issued Robert Moore shares of common stock in exchange for this contribution. Cash and a truck were received by the business. Cash and truck are both assets. We increase assets with a debit. So we are going to debit cash and debit truck. Remember, we always list debits first. The amount of the cash received was $20,000. And the amount of the truck was $13,000. In exchange for this cash and the truck, More Delivery Service issued common stock. Common stock is a contributed capital account. We increase a contributed capital account with a credit. So I'm going to indent just a little bit and write in my account that I will credit common stock for the sum of my debits, $33,000. My debits and my credits must always equal. We call this balancing. My debits and my credits balance. Next, on December 1st, More Delivery Service paid $1,800 cash for a 12-month insurance policy. The policy begins on December 1st. This insurance policy is an asset called prepaid insurance. It's a resource to us because we will be able to use it for several months. We increase an asset with a debit. So I will debit prepaid insurance. $1,800. And we paid cash to purchase this insurance policy. Cash is an asset. If we paid cash, that means our cash is decreased. I decrease an asset with a credit. So I will credit cash. I indent just a little bit. I always list my debits first and my credits last, and that's what I'm doing here. All right, my debits and credits equal. On December 4th, More Delivery Service paid $700 cash for office supplies. This purchase of office supplies has resulted in the acquisition of a new asset, office supplies. We increase assets with a debit, so I will debit office supplies. $700. And we paid cash to purchase these office supplies. Cash is an asset. If we are paying cash, that means our cash is decreasing. We decrease an asset with a credit. So credit cash, $700. On December 12th, we performed delivery services for a customer and received $1,600 cash. Cash was received. Cash has increased. Cash is an asset. We increase assets with a debit. So I will debit cash because I always list my debits first. $1,600. Okay. And I've also increased my equity account revenue. We increase revenues with a credit. We can recognize the revenue because the delivery services have already been performed. Credit, service revenue. Increasing my revenue account with a credit here. My debits and credits balance. On December 15th, we completed a large delivery job and billed the customer $2,600. And received a promise to collect the $2,600 within 1 week. We did not receive any cash for this transaction because the customer hasn't paid us yet. Instead, what we receive is a promise to pay. That's an accounts receivable. Accounts receivable is an asset. It's a right to receive cash at a future period. We increase assets with a debit. So I am going to debit accounts receivable. $2,600. And because we have already completed the delivery job, we can recognize the revenue. We record revenues with a credit. Credit service revenue, $2,600. On December 18th, we paid employee salaries $1,300. If we make a payment, that means cash has decreased. Cash is an asset. We decrease assets with a credit. So cash will be the account that we credit. But we need to record our debit first. What account do we debit? Salaries expense. We record expenses with a debit. $1,300. Credit cash to show the cash payment. $1,300. On December 20th, we received $3,000 cash for performing delivery services. Cash was received. That's an increase in cash. We record an increase in cash with a debit, so we will debit cash. $3,000. And it tells us that the delivery services have already been performed, so we can record the revenue. We record our revenue with a credit. Service revenue, $3,000. On December 22nd, we collected $1,300 in advance for delivery services to be performed later. The $1,300 cash collected is an increase in cash. Cash is an asset. We record an increase in assets with a debit. However, the delivery services have not yet been performed, so we cannot record a revenue. What we have is a liability. We record an increase in liabilities with a credit. That type of liability is called an unearned revenue. And we're in balance. On December 25th, More Delivery Service collected $2,600 cash from a customer on account. This is related to that earlier entry on December 15th, where we billed a customer for a delivery job that had already been completed. Now we are collecting the cash. Cash was collected, so that means cash is increasing. Cash is an asset. We increase assets with a debit, $2,600. And we don't record a revenue because we already recorded the revenue back on December 15th. We don't need to record it again. Instead, what we are going to record is the reduction in the accounts receivable. It's no longer receivable because it has been received. The customer paid off their account, so we need to remove this accounts receivable. We are going to decrease accounts receivable with a credit because accounts receivable is an asset account, and we decrease asset accounts with a credit. On December 27th, More Delivery Service purchases fuel for the truck, paying $200 on account. The purchase of fuel is an expense. We record an expense with a debit. So I'm going to debit fuel expense. And I am going to credit accounts payable because we said we purchased this on account. That means we didn't pay for it. Accounts payable is a liability. We increase liabilities with a credit. On December 28th, we performed delivery services on account $1,300. Delivery services were performed, which means that we can record the revenue. We record a revenue with a credit. We're going to record that second because we always write down our debits first. So what is our debit? These delivery services were performed on account, which means we haven't been paid. So instead of recording cash, we are going to record an account receivable. Accounts receivable is an asset. We increase assets with debit. So I will debit accounts receivable. $1,300 and credit service revenue. $1,300. We are in balance. On December 29th, we paid office rent $1,900 for the month of December. Since this payment was only for the current month, we're going to go ahead and record this as a rent expense. We record an increase in expenses with a debit. Debit rent expense. $1,900. And we paid for this, so that means cash is decreased. Cash is an asset. We show decreases in assets with a credit. Credit cash. On December 30th, we paid $200 on account. This was related to our earlier December 27th transaction where we purchased fuel on account. We didn't pay for the fuel on December 27th. We set up an account payable. Now we are paying for that fuel, so we need to remove that account payable. If we remove an account payable, that means we need to reduce the accounts payable balance. Accounts payable is a liability. We reduce liabilities with a debit. To debit accounts payable. And we paid off this accounts payable, so that means we have decreased our cash. Cash is an asset. We show a decrease in an asset with a credit, so credit cash. On December 31st, cash dividends of $3,000 were paid to stockholders. We record an increase in dividends with a debit. Debit dividends. Cash was paid for these dividends. Cash is an asset. We show a decrease in an asset with a credit. And those are our journal entries for more delivery service for the month of December.